Hi, good day everyone, and welcome to this very special masterclass on the LIBOR transition. Now, about November 2020, we had started talking about the LIBOR issues and the key moves that the central banks in this region have to make in order to comply with the end of the LIBOR standard. And of course, this was all kicked off by the LIBOR rigging scandal, which was exposed shortly after the 2008 global financial crisis. So that had highlighted the need for more transparent and reliable financial benchmarks. And we are still moving towards that journey. And of course, recently, various central banks and most notably the EU Commission and the ECB have again stressed that participants need to stop using the LIBOR framework and that it's rolling off. But we really wanted to get into the nitty-gritty of these issues. And so I'm very pleased that we've been able to invite Dr. Periklis Thivaios, who's a partner and also the IBOR lead at TNP Partners, to come and talk about a range of issues related to the LIBOR transition. And True North Partners is a UK-based consulting firm with very deep expertise in the LIBOR transition programs across various jurisdictions. So one of the things we wanted to ensure in this webinar was we wanted to get into the detail of the issues and really focus on those. And so what we'd really like, we obviously have a Q&A box here for you all to keep your questions coming through the webinar. But at the very start, if we can, please just pop in the key areas where you really want Dr. Periklis to focus on and to look into, because then we can ensure that the webinar is as focused on what you need it to be as possible, and of course then we can really ensure we have a good discussion. So that's I think enough from me. Let me pass over to Dr. Periklis to kick off the webinar.
Aziz, thank you so much for the introduction, and good afternoon everyone. It's a pleasure presenting this webinar to you. As Aziz mentioned, the transition process has been happening for quite some time now. I sadly have to admit that I've been working exclusively on LIBOR transition for just over 2 years now, which sometimes makes me question what I've been doing with my time for the rest of it. But the important point I wanted to make is that we're going to try to get a little bit more technical today. I'm sure you know about the transition. I'm sure you've heard what the new RFRs are. You've heard what SOFR is, what SONIA and the like. So I would like us to go a step deeper, just trying to look under the hood. What does this mean from a conventions perspective, from an interest accrual perspective? What does it mean? What are the implications of the developments that are taking place in the term rates space? We're also going to touch a little bit on Islamic finance and the implications that we're seeing there, particularly in light of the Standard 59 development that we had over the last few months. And obviously, we'd like to see what are the expectations, or what is some guidance that we could give to central bankers like yourselves for your respective jurisdictions. As Aziz said, we're very open to having questions. Please feel free to post them. I'll be very glad to take them on throughout the conversation. If at any point we have to park a question for later, we may do that as well. Without further ado, and while waiting to see if any messages pop up in the chat, I'm going to continue. But please do send any questions you have even at the beginning, so we can customize the structure and we can make sure that we address your questions in specific. Oops, okay. So in terms of the outline of what we're going to do, we're going to provide a little bit of an introduction, probably things that you already know, but it's a healthy step to just make sure we're all on the same page. We're going to look at RFR conventions in more detail. As I said, we'll talk about term RFRs. We will also touch on US dollar LIBOR alternatives. You may have heard a lot of noise around them. What are they? What do they mean? And what do they mean for us in non-USD jurisdictions? We're going to talk, as I said, about Islamic finance, and then some expectations with regards to the regulatory process and supervisory examination. Aziz already mentioned the LIBOR rigging scandal. We don't need to repeat much of what happened and the timeline. It's been going on for 11 years, more or less now. But the bottom line is that the end game at the moment of LIBOR is clearly in sight. Why? Because on the 5th of March of this year, just a few months ago, the Financial Conduct Authority of the UK officially announced the discontinuation of LIBOR fixings, and the discontinuation or the cessation dates will be as follows. At the end of this year, only 6 months away, all Euro LIBOR tenors, all Swiss franc, Japanese yen, and sterling LIBOR tenors will cease to be published. So at the beginning of next year, when you go to your Reuters, or Refinitiv, or Bloomberg screens, you will not be able to find a Euro LIBOR fixing or a Swiss franc LIBOR fixing, with some exceptions, potentially in the Japanese and sterling space, where there may be a synthetic LIBOR, but this is, let's call it a detail, unless anybody has any questions on it later. So all tenors, all 7 fixings of these LIBORs will cease to be published. In addition, the 1-week and 2-month US dollar LIBORs will cease to be published at the end of this year. This is probably of less significance because these are not very heavily used tenors. And in addition, even though they will cease to be published, interpolation will be applied moving forward. Again, if anybody has any questions on that, I'm happy to expand on it. But as an introductory level, I think what we need to keep in mind is that the 2 US dollar LIBOR fixings that are seized at the end of this year are not the ones that are very heavily used. The next important milestone is the 30th of June 2023, where all the remaining US dollar LIBOR fixing will cease to be published. And this is, let's call it the complete end point of LIBOR. Now, we do need to keep something in mind. So in November last year, the several regulatory authorities announced simultaneously that some US dollar LIBOR fixings will continue to be published until the 30th of June 2023, but that is for legacy contracts only. No new US dollar LIBOR issues will be allowed as of the end of this year, and this is something we need to keep in mind. So if we have a current contract that is referencing US dollar LIBOR and it matures before the 30th of June 2023, we can actually allow it to continue on US dollar LIBOR and mature normally without having to remediate it. However, if a client comes to us on the 3rd of January, or whichever is the first working day in your country, in 2022, and asks for a new US dollar denominated loan, that would have to be issued on the alternative reference rates. So this is something really important to keep in mind. Extension of US dollar LIBOR publication timelines for 1.5 years further does not equal that we can continue using US dollar LIBOR up until then. We can only use it for contracts that have already been written within 2021. And we will still need to make sure that these contracts are appropriately papered, they have fallback clauses, etc. Now, let's take one more step back. We started with a rigging scandal. We know that there was whistleblowing, there was several law cases, banks got massive fines, eye-watering fines, if I may call it about that, and the foundations of the financial system were challenged because we are now not confident about the integrity of those LIBOR rates that are being developed. On the back of that, the IOSCO, which is the International Organization of Securities Commissions, published 19 principles for benchmark administration. Now, the most important ones that I would like to touch upon a little bit on this discussion are the following 3. First of all, with regards to benchmark design, IOSCO says that the design of the benchmark should enable an accurate and reliable reflection of the economic realities that this benchmark seeks to measure. And this is something that LIBOR was clearly failing to achieve. And we'll come to this point on the right-hand side of this slide. Data sufficiency is another one of the 19 principles, which is worth highlighting, that the data that is used for the creation of financial benchmarks should be anchored in observable transactions. LIBOR submissions are based on expert judgment primarily. Well, there has been a reform of the LIBOR process as well for the ones of you who have been close to it in 2013, but nonetheless, we still see a higher prevalence of expert judgment. What regulators and what IOSCO said is that the data used should primarily be based on observable transactions. Of course, IOSCO appreciates that we will not always have sufficient data for observable transactions, and sometimes we may have to use expert judgment. But they introduce the concept of a hierarchy of data input, where they say that expert judgment should only be used as a last resort and not as the incoming hypothesis. So 19 principles. These are 3 of the most important ones. Let's have a look at benchmark design and what is the problem. What you can see here in the graph is 3-month LIBOR, SOFR, and Fed funds for a recent period that includes the COVID pandemic. Yeah, so it includes Q2 of 2020. And what we can see here is that SOFR trailed Fed funds quite well. So the Fed, the Federal Reserve of the United States, wanted to drop interest rates in order to incentivize the economy, to stimulate it, to stimulate economic activity, and they dropped the Fed funds rate, the effective Fed funds rate, to nearly 0. And SOFR is also, you can see it's trailing and it's dropped really low. What is interesting though is if you look at the blue line, which is LIBOR, this one spiked. And this was a confirmation to the regulators that there's something fundamentally wrong about LIBOR. At the moment when they wanted their monetary policy to incentivize economic activity with lower rates, LIBOR instead moved on the opposite direction. And as a consequence, even though we saw a number of regulatory initiatives being delayed, for example, you are familiar with the Basel Committee delaying the implementation of Basel III by 1 year, the timelines for the LIBOR transition remained as is, because as we can see exactly a year ago, we had a new proof of why LIBOR does not work. And this is clearly illustrated in the graph on the right-hand side of this picture. Now, let's have a look a little bit at some of the most significant timelines. And I don't really want to focus on what has happened historically. Let's start from May 2021. This is a point that we will touch a little bit later. CME was selected as the term SOFR vendor by the ARC. What is coming up next, again, within the US dollar context, that's going to happen on the 26th of July this year. The interbank dealer market will work on a SOFR first principle. All interbank dealer quotations will be based on SOFR instead of LIBOR, which is something that's been happening right now. This is something that's happened in the UK since last year. I mean, for all of you, you may be aware that the UK is quite a number of months ahead of other regulators and definitely the United States in terms of the transition. But now the United States is following suit and they also announced the SOFR first initiative. Towards the end of this year, we're expecting clearing houses to switch over for swaps referencing LIBOR. Again, these swaps will be migrated to the alternative reference rates. And at the end of December of this year, we have the cessation of the tenors that we discussed earlier. We have the cessation of the publication of EONIA in the ECB area. And there's only a limited number of circumstances where banks can enter into new USD LIBOR contracts. And this is basically just for hedging purposes. And this takes us all the way to July 2023, where we have the final cessation of LIBORs. As I mentioned earlier, there is a fair bit of discussion around synthetic LIBORs, especially for sterling and Japanese yen. This is something that is still a work in progress. As you may be aware, the FCA Financial Services Bill consultation is open as we speak. We're expecting the results actually shortly in terms of how should the FCA apply its new powers out of that bill in order to designate benchmarks, critical benchmarks, and manage them moving forward. Now, what is important to keep in mind is that these timelines are the things we know. And unfortunately, as always, there's a lot of unknown unknowns. And that's why being prepared and following through the guidelines is very, very important. And making sure that the banks within the jurisdictions that you supervise are also closely attending to all the issues and are up to date with the latest announcements that are coming from regulators, which are coming pretty much on a weekly basis. Now, I'm not going to spend a lot of time on this slide, but just quickly for everybody's benefit, we know that US dollar LIBOR will be replaced, or at least the preferred rate for replacing US dollar LIBOR is the secured overnight financing rate, which is SOFR. SONIA is the preferred rate for sterling LIBOR. In the UK, things are a lot clearer. SONIA is not just the preferred rate, it's pretty much the only rate that is coming through. Within the Eurozone, we have Euro STR, but please do keep in mind that Euribor is still available. Euribor should not be confused with Euro LIBOR. These are two different benchmark rates. And even though Euro LIBOR will cease to be published at the end of this year, Euribor has been reformed and will continue being available at least for the foreseeable future. Having said that, the ECB has been very clear that they do foresee Euribor to be decommissioned at some point as well, and they have already requested all banks dealing in Euribor to include appropriate Euro STR-based fallbacks. In terms of the Swiss franc, we have Saron, and in terms of the Japanese yen, we have primarily Toner, or Tona. It's the exact same rate. You can pronounce it whichever way you want to. I'm not going to go through the details in this graph. You can study it at your own time if you want, but I do think that it's important that we look at some of the fundamental differences between LIBORs and the proposed alternative reference rates. And why is this important? The reason is that we're not just replacing LIBOR with another rate. It's not as simple as saying, okay, if something previously was priced at LIBOR +1, now it's going to be SOFR +1. And the reason being that there are some fundamental structural and economic differences in terms of these rates. So let's have a look, and I'm going to focus on the first three, not on all five of them. First of all, as we already said, the source data for LIBOR has been heavily expert judgment based, whilst all the alternative reference rates are anchored in actual and observable transactions, fundamentally based on the principles provided by IOSCO that we discussed earlier. Now, where do the economic differences start coming in is in point number 2. LIBOR embeds an interbank credit spread because LIBOR is a representation of the funding cost, the borrowing cost that the global internationally active bank would be able to borrow at an arm's length for a specific tenor, right? So if a bank borrows from a bank, some sort of credit spread will be embedded to reflect the credit premium of the borrowing banks. When we're looking at the alternative reference rates, these rates are nearly risk-free. Now, why nearly? Because if there's one thing that we learned in 2008, that there's no such thing as risk-free rates. So the attempt of the regulators is to make them as risk-free as possible without this meaning that that these rates are absolutely risk-free. But simplistically speaking, and what does it matter for us? We can assume that ARRs, especially RFRs being a subset of ARRs, so ARRs are alternative reference rates, RFRs are risk-free or nearly risk-free reference rates. So RFRs are lower than the respective LIBORs. If somebody was previously pricing at LIBOR +1, the rate, the pricing for the alternative reference rate should incorporate an additional adjustment that takes into account that interbank credit spread. Last point that I want to discuss in terms of the fundamental differences, and again, I appreciate up until now, these are maybe things that you're all familiar with, is that LIBORs are available in over 7 tenors, whilst RFRs, at least in the raw format, are backward-looking, and the term structure is developed based on the underlying derivatives markets. So we know that SONIA, there is a term SONIA reference rate, a TSRR, which is already available for use in some specific transactions. We've made some progress with regards to the term SOFR. We'll come to this in a little bit. Japanese yen also now comes with comes on a term structure, and of course TIBOR has been reformed. That's also an alternative. But if we look at SARON, for example, the Swiss LIBOR alternative, there is no term rate, and the local regulator and the administrator have said there will never be one, simply because there's not enough underlying transactions to support the development of such a rate. So summary of this slide is that we're not just moving from one rate to the other, because the new rates are fundamentally different and they have different economics. And this has these are where some of the most important consequences are coming because of this transition. Now, just quickly to get a little bit deeper on this, the different reference rates that have been proposed have different characteristics as well. What you can see on the left-hand side, in the brown circle, in the dark gray circle, is that all alternative reference rates are transaction-based. Again, we've said that IOSCO was pretty clear about this. Now you can see that some of those rates are collateralized. This is the blue circle. So SARON and SOFR are collateralized. Some of them are not. And again, some of the rates include non-bank counterparties. Some of them do not. There's pros and cons to each of these designs. but this is beyond the scope of our conversation. Why? Because there's no benefit in us academically analyzing whether these rates have been set up appropriately or not. These rates are what they are. What is important for us is to understand their composition, their construction, and be able to implement, taking into account these different characteristics that each of these different rates entails. So you can see the discussion of the pros and the cons. As I said, this is purely a theoretical discussion, but practically we do need to know that SOFR, for example, is a collateralized rate. This has some benefits, but it also has some downsides, and the same applies to all the other rates. Now, just closing off this section, what we also know is that when the announcement came from the FCA on the 5th of March, we already mentioned this on the first slide, with regards to the announcement of the cessation of LIBOR fixings. That was also a trigger event for the fixing of the credit adjustment spreads, which are basically the adjustments that we need to apply in order to the extent reasonable, equalize LIBORs with alternative reference rates. Simplistically speaking, one could think of it as the following: LIBOR equals RFR plus CAS. Now, of course, I want to repeat, this is relatively simplistic and it's not exactly accurate, but it does give you an indication that when you're supervising your banks and you're supervising at their pricing models, you want to make sure that the way that they've calculated and they've applied the CAS is reflective of international trends, so that your customers, the clients, the borrowers in your jurisdictions are treated fairly, and there's no value transfer from the borrowers to the lenders, or potentially vice versa. Now, this is all nice and good, and we can see this table that you can pull it from Bloomberg at any moment. I mentioned Bloomberg here because Bloomberg is the approved data vendor for ISDA, and ISDA is the organizers that came up with the methodology for these CAS adjustments. And then subsequently the ARC, the UK RFR working group, etc., they adopted the ISDA methodology. So you can get these rates from Bloomberg. The fix there is what you see on this table. But here are some of the challenges that we need to keep in mind. These rates, these CAS, these credit adjustment spreads, have been developed based on a 5-year history of the spread between LIBOR and these RFRs. And as we know, at the moment, we are in one of the lowest interest rate environments ever experienced in modern times, if not the lowest period. And therefore, the historical averages are not reflective of the spot spreads that we're seeing today. So let's just have a look. Let's assume that currently we have a 3-month US dollar LIBOR fixing that we need to migrate over to SOFR. So let's look at the bottom table on this graph, and let's look at the 3-month row, which is the one before last on the table. The adjusted SOFR, and I'm going to ask you to please do not get confused about the concept of adjusted SOFR for the purposes of this discussion. This is a concept that has been introduced by ISDA, but let's say that SOFR, or the adjusted SOFR for 3-month US dollar LIBOR, on the 26th of March, when I did this calculation, was 0.05%. The CAS, as per the table above, if you look at the USD column and you look at the 3-month row, is 0.26161, or 0.26%. So as we said, theoretically speaking, LIBOR equals SOFR plus spread. Adjusted SOFR plus spread in this specific calculation is 0.31%. But US dollar LIBOR is at 0.19%. So what this means that if we were to apply this methodology as is, then we would end up with a value transfer of 12 basis points from the borrower to the lender under the current interest rate environment. So this now starts begging a number of questions. What is the appropriate credit adjustment spread to apply given this potential value transfer? And we can go into a lot of details here. If anybody has any questions, I'm glad to respond. The guidance, and that was confirmed by the FSB only 2 weeks ago, is to use the ISDA credit adjustment spread, but you can immediately see the challenges that such a choice would have, right? We would have to tell the client that their all-in rate would go up by 12 basis points. Again, I repeat, based on the interest rate environment that is captured in this snapshot here on this page. Obviously, things may evolve differently over time, and we have to see what will happen. but do keep that in mind. We do need to account for the risk-free nature of these alternative reference rates, but at the same time, the way we account for it, unfortunately, is not as straightforward as we had thought or we would have hoped. If there's no questions, and I'm just looking now at the chat, I would like to start going a little bit deeper. Up until now, it's probably things you've heard before. Let's start looking at the conventions for RFRs. What is really important is that the rate has changed, the economics of the rate and the construction of the rate has changed, but also the way that the rate is used in order to calculate interest accrual has also changed. And this is where things are becoming a lot more complicated. Unfortunately, a system that can make daily accruals for LIBOR is not, most likely is not able to account for the backward-looking nature of RFRs. And the backward-looking nature is captured by the decision tree that starts with in arrears. Of course, there's been some rates that have been set in advance. I'll come to this in a little bit. Now, in terms of in arrears rates, there's a number of additional parameters that are important to have in mind when you're thinking in terms of how do these apply and what do they mean for the companies that you're supervising. The concepts that we need to think of is the observation period, which is the darker blue box, and the interest period. So simply speaking, the interest period is the period for which interest gets accrued. So if we start a loan today and it's a 1-week loan, the interest period is from today until the following week, Tuesday. Having said that, as you can see in some of the cases here, the observation period has been shifted. And I would like to draw your attention to the fourth row where it says look back with or without observation shift, which does seem to be the most prevalent convention that is going to be followed in terms of loan products. And in that one, the observation period has been shifted backwards by 5 days. So what you can see here on the right-hand side, on the, let's say, the illustrative bars, is that even though the interest period starts today, on the middle dotted line, the observation period has started 5 days earlier, K days earlier, but it's mostly 5 days. Practically what this means is that under the look-back convention, the payment notice is known 5 days in advance of the completion of the interest period. And therefore, the payment date itself can be at the end of the interest period. If we look at other conventions, you can see that, for example, if you have a payment delay, the observation period and the interest period remain identical. And then what this means is that the payment is known only at the end of the lending period, and the payment date can only be a little bit later, clearly because we need to have the time to create a notice of payment, send it to the client, and the client needs to pay within the timelines. But effectively, one of the reasons why these conventions have come about, especially within the in arrears universe, is because we're now looking at backward-looking rates, and we want to create some sort of economic certainty, at least for a number of days, which again is still problematic if you think about it. Because if you now set up a 90-day US dollar LIBOR deal, both the banks that you're supervising and as well as the borrowers know already from the very beginning what they will pay at the end of the interest period. They're going to take the current 90-day US dollar LIBOR, they will multiply it by 90 days, divide by 360, talking about the US and their respective conventions, multiply this by the balance, and there you go. They can raise the provisions from day one, and they know exactly what they need to pay at the end of the period. With RFRs, this is not possible, definitely not under the in arrears convention methodology. And what we've tried to do is to at least give a notice of payment 5 days in advance of the conclusion of the interest period, which is a little bit better than knowing only afterwards, but obviously is not the same and is definitely not as convenient as it is with LIBOR. Now, in order to account for this, regulators have also, well, industry bodies, to be fair. No, it's not just this process has been performed incredibly closely between industry bodies, market participants, and regulators alike. So what these parties have proposed also is an alternative convention methodology, which looks at rates in advance. And in advance means that we take the historical rate and we apply it moving forward. So if you look at, for example, the last reset, you can take the previous 90 days, you take the average, the compounded average of SOFR in the US dollar example, and then you apply it for an interest period 90 days moving forward. So to some extent, at least we have the certainty that we had with LIBOR, but the challenge here being is that the rate that we're using has been based on historical observations. It does not necessarily take into account future expectation of rate changes, something that LIBOR did. But again, to be fair, it did that primarily on an expert judgment basis, which can be questionable in terms of its integrity. So just to summarize, in terms of options for compounding RFRs, in other words, options for accruing interest, for calculating what is the interest due at the end of the interest period, can be split between in arrears and in advance. In terms of in arrears, the look-back approach is probably the most common and the one that has been recommended by the various industry bodies, including the ARC in the United States. But then also we do have the option of using in advance. In advance has been recommended again by the ARC, for example, for intercompany transfers, where the actual rate to be used matters a little bit less, if I may say, loosely speaking, because it is between the same between two companies of the same group. And there we do want to have some knowledge in advance of what the rate is going to be. But there are a fair few challenges of using in advance, and this is why the market is primarily looking into adopting RFR rates in arrears. Again, I'm going to come back to in advance rates when we start having the term RFR discussion. But in terms of pure RFRs, these are backward looking. We either calculate them in arrears and we compound interest overnight every single day, or we take the historical average, whether it's the last reset, we use the entire period shift, or using a shorter period, and we apply it on a moving forward basis. Now, the things are still not as, they're still even more complicated, because even if we want to follow the look-back approach, we have to make a decision between using simple versus compound averaging. And maybe not to confuse you with the technical details. You can see the formulas here. For the ones who are mathematically inclined, they do not seem that scary. For some other of us, they may do. But the bottom line is the following. Especially under the current low interest rate environment, the difference in terms of the interest accrued between the two different approaches is almost negligible. But from an operational perspective, from a systems and accounting accruals perspective, it's the more prudent approach is to be prepared to apply both. And why? It's simply because the conventions have not settled across jurisdictions and even within jurisdictions. And some contracts may employ compound in arrears interest formulas, while others can employ simple interest in arrears formulas. Now, in the United States, the LSTA, which is, let's call it the US equivalent of the LMA within the Eurozone, has strongly favored the simple interest in arrears approach. But that does not mean that we do not see compounded in arrears SOFR deals taking place at the moment. So bottom line of all of this is that we have to be prepared for both. Our supervised entities and our borrowers should be prepared to calculate interest accruals based on both the methodologies. But practically, and especially right now that interest rates are so low, the practical difference between the two is very, very low, which is a little bit of an annoyance if we think about it. We have to invest so much time to understand these formulas and to implement them for a tiny difference in the actual cost. So let's have a look. Let's illustrate it. I always think a lot better when I see tables than when I see mathematical formulas. So what I've done here on this table, I've decomposed simple interest and compound interest. Please note that this is a very old example. It's based on rates from 2019, but it also helps a little bit from an illustration perspective. That's why it has not been updated. It is better when we're using higher rates. You can see that so far, annualized is around 2.4%, 2.5% at that period versus what it is right now, which is incredibly lower. Now, if we look at the table on the top, simple interest, we're assuming a 5-day loan. We're ignoring any specific lookbacks and observation shifts. We'll come to this in a little bit. So for the Monday, 7th of January, on the simple interest table on the top, we take the SOFR rate. We weigh it for 1 day, for Monday to Thursday, but you see for Friday, we apply this rate for 3 days. And again, this makes sense because interest has to accrue over the weekend. But over the weekend, at least on a US calendar, there's no publication of rates. So we apply a weight of 3 to the Friday rate, and the same we would do when it comes to public holiday. And then the unannualized effective rate here, which is column A, as you can see, is the weight, number 1 or number 3, times the rate divided by 360. And 360 again being the day count convention that is prevalent in the United States. In the United Kingdom, this is 365. But again, this is a detail. Let's focus on the US dollar environment. We take this effective unannualized rate and we multiply, and we have B, which is the principal amount. And then you can see on the last column, the interest charge for that business day is A times B. The column that has principal plus accumulated interest is for illustration only for this specific example when it comes to simple interest, because this is not relevant. The interest charge is A times B, which effectively is the same what we're doing in a LIBOR environment, with the difference that instead of taking the LIBOR rate that is known in advance, now we have to perform this calculation overnight or on T+1 in order to calculate the interest accrual for the night before, for the 24 hours before us. And you can see that the total interest charge for this hypothetical example, after 5 days on Friday, the 11th of January of 2019, in this example, is $200.83. Now, if we look at compound interest, any of you that have sharp eyesight and they can read through tables easily, you will see that the majority of these columns are identical. You can see that the number of days that the rate is applied is the same. SOFR is, of course, the same. The effective rate is the same. The principal amount is the same. And column C is the same, the principal plus accumulated interest. This is also the same as above. But what changes in terms of compound interest? Instead of multiplying column A times column B, you're multiplying column A times column C. In other words, compound interest takes into account the accumulated yet unpaid interest as part of this process. For what you can see on the bottom right is that the total accrual for this example is $289. So for a $1 million principal amount, the actual difference in the interest accrual, and for rates that are multiples higher than what we see today, is only $6 cents. So pretty negligible, comes to my point earlier. Of course, if at some point SOFR rates go up to 6 and 7%, I hope not, but who knows? We've seen the inflation forecast, etc. This may change, but for the time being, and for low interest rate environments, you can see that the difference between the two methodologies, the two conventional methodologies, is very, very low. There's something else I would like you to keep in mind, again, because I would like this to be a more technical discussion, is in some jurisdictions, and I would be very keen if this is the case in your environment, applying interest on interest may be forbidden by law. This is something that within the Eurozone is explicit in Germany and Italy, and also in France. In France, with the slight nuance that you can apply interest on interest if the loan has been outstanding has been delinquent for more than 1 year. But the bottom line is that there are cases, there are laws, national laws, that may make the application of compound interest more complicated. Now, just to give further perspective, there's been a fair bit of study, including from the LMA, and the proposal there is that we should not think of compound interest conventions as a means of applying interest on interest, but instead just as a different accrual methodology. So it is possible that we could use compound interest even in those countries, but there's no case law at the moment. So this is something to be seen. But again, as supervisors of your entities, when you're looking at conventions, please do have a discussion within your central banking committees or your IBOR working groups with your respective banks in terms of how could compound interest be interpreted and whether that would be consistent with the local laws. But again, bottom line is that, as you can see, we have to go through all these complexities for just 6 cents of difference on a $1 million loan, which is obviously something that's really, really low. I'm not going to spend time on this slide. Effectively, again, it just makes our life more complicated, because as if it's not only that we have to choose between in arrears and in advance. We don't only have to choose between simple interest and compound interest. We also have to choose between cumulative versus non-cumulative compounding. And cumulative means that we compound the the interest on blocks of periods. Non-cumulative is when it's been done overnight. What I would like for you to take as a takeaway from this slide is that, generally speaking, the non-cumulative approach can be more accurate, and it can be applied in cases where we have intra-period changes in balance. So if we're looking at prepayments, asset sales, or revolving facilities, cumulative approaches would not be able to accommodate those. But the downside is that non-cumulative approaches are more complex, both to implement from a system perspective, but also to document from a legal perspective. From a systems perspective, I'm not as concerned. You built it in the system once and it's there. But for any one of you that has seen the LMA's recommended forms for rate switch agreements, you will have seen how many pages the LMA has to devote in order to explain cumulative compounding and put it in legal words, if I may. So there is a little bit of a trade-off that needs to be kept in mind there as well. The one convention I do want to spend some time, and this is something that's confusing a fair few people, myself included, for several days, if not weeks, when I start wrapping my head around it, is whether we're looking at look back with or without observation shift. Let's take a step back. You remember that we said conventions can be in arrears and can be in advance. And in arrears conventions, there's one convention that is called the look back. That was the fourth row that I said is becoming the more prevalent. But now within this look back approach, we have some further granularity or some further options that one needs to apply. And the question there is whether we apply an observation shift or we do not. Again, before I go through the technicalities, I want to start with a big picture. Fortunately or unfortunately, for the vast majority of days, the difference between look back with or look back without observation shift is zilch, is zero. But there are some cases where it does make a difference. And the one case that is illustrated here is one of them, right? Is one case where we can see some differences. And where does that happen? Primarily, it happens when we have some sort of public holiday. So you can see that the Monday of the 27th of May is a public holiday in the United States. Well, for the year that we have used here in our example, right? Again, 2019, I'm afraid. So the 27th of May was a public holiday in the United States. There were no rates available. We want to calculate an interest accrual on Monday, the 3rd of June. And there, because we have a 5-day look back, as we've discussed earlier, we have to look 5 business days back in order to pick up a rate. And the 5 business days takes us to Friday, the 24th of May. Again, as I said, whenever we do not have a public holiday, the 5-day business look back will generally take us from a Monday to a Monday and from a Tuesday to a Tuesday. But in this specific example that is been selected precisely for that reason, the 5 business day look back takes us to a Friday. It takes the Monday observation date to a Friday. Now, you can see on the penultimate column, we have the lag, which is the without observation shift approach. And on the last column, we have the backward shift, which is the with observation shift column. In both of these examples, when we want to calculate the interest rate appropriate for the Monday, the 3rd of June, we're taking the rate from 5 business days before. So you see both examples are taking the 2.37 rate of SOFR from Friday, the 24th of May, which is selected in an amber, in a dark orange circle. What changes is the weight that we are applying in order to calculate the actual rate. And if you remember, again, let me just scroll backwards. You can see that here in this specific example, on the Fridays, we have number 3, whilst for the other days we had number 1. But on the example here, for Friday, the 24th of May, the weight is 4, right? Because we have 3 non-business days following the Friday, the 24th of May. So when we come into the backward shift column, the rate is calculated by taking 2.37 times 4 divided by 360. That's the approach with observation shift. The approach without observation shift, instead, though, takes the weight from the observation period. From the interest period, not the observation period. In other words, the rate for Monday, the 3rd of June, under the lag approach, takes the rate from 5 business days before, but weighs it by the weight of the same day, the Monday, the 3rd of June. And this is why we have a difference in terms of the two rates that are calculated under the with or without observation shift approaches, under the lag or the backward shift approaches, right? This is something that takes time to comprehend. It takes time to explain, especially when we think of it from a treating your customers fairly perspective. We have to go and explain to our supervised entities, and the supervised entities respectively, they have to explain to the borrowing customers what's the difference between these two conventions. And in all honesty, this confuses the heck out of pretty much everyone. And even worse so, confuses the heck out of everyone for a calculation that unless there's been a public holiday, simplistically speaking, there's no difference, right? And again, you can see why understanding the mechanics, the technical details of the transition is very important, and it's not as simple as saying that, oh, we substitute LIBOR with SOFR. Now, again, in the US dollar environment, there seems to be a preference for without observation shift, but this is not something that we can say that is universal, at least not at this moment in time, right? So it is important that we prepare to understand and implement all of these permutations of approaches in arrears or in advance, simple average versus compound, cumulative versus non-cumulative, and with observation shift or without observation shift. So you can see how many different conventions need to be implemented, conventions that simply did not exist previously. Previously, all we cared about was the day count convention and maybe the preceding or following business day convention. Now these are augmented by all these other decisions that we have discussed within the previous few slides. So please pay that in mind, keep that in mind, but also pay attention to the fact that, as I said, most of the times, for the vast majority of days, the difference between the two is 0. Just for everyone's reference, and without having to spend time on this, I've selected all the ARC conventions for different products, and I've provided the links. So if anybody would like to see the conventions for US dollar provided by the New York Fed and the industry body that's under the New York Fed, which is the ARC, you can follow these links and you can find out the conventions for these different types of products. This has concluded our section on conventions. And I appreciate there's a lot of detail there. And I'm very open to taking any questions potentially later in the conversation, whenever you feel that you've been able to articulate it. What I would also like to do is now to start focusing a little bit on term RFRs, because it's an important step of the transition. It's something that a lot of banks and other market participants are asking for, but it's something that is still a work in progress. Let's first of all have a look at the overall view in terms of what's happening with regards to term RFRs. And again, just to be clear, term RFRs are forward-looking term rates that are fundamentally based on risk-free rates. So these RFRs themselves are risk-free. So we come a step closer to LIBOR in the sense that we can get a 1 month or a 3 month or a 6 month fixing that is forward-looking, but it still does not embed that credit premium that we discussed earlier. With regards to the US dollar, term SOFR is, well, it's currently published by the CME. I'm going to come to this actually on the next slide. Let's park term SOFR just for a second. In terms of term SONIA, for the sterling LIBOR or for the sterling environment, this rate has been available as of the 11th of January, and you can find it from 2 different vendors, the Intercontinental Exchange Business Administrator and Refinitiv. Both vendors have been approved by the FCA, and you can use the rate from either of the vendors. In terms of term Euro STR, this is still a work in progress. We do not know when it's going to be available. There are some indicative rates though that are provided by the ECB, and I've provided the link here on this page. With regards to the Japanese yen, we have the Tokyo term risk-free rate, or TORF as it's known. It's been available for about a month now, or actually 2 months now. And again, you can find it in the following links that have been provided. I mentioned earlier that within the Swiss franc environment, there will not be a term rate for SARON, right? And this is why the Swiss franc is not included in this table. Now, let's focus a little bit on the US dollar term rate, which is generally what is the most relevant for countries outside, let's say, the Eurozone or the United Kingdom. So on the 21st of May, just about a month ago, the ARC announced that it selected the CME group as the administrator that it plans to recommend. Please pay attention to this. It plans to recommend for providing the forward-looking term SOFR rate once market indicators for the term rate have been met. So basically, the ARC said that, yes, we will endorse the use of the term rate that is provided by the CME group, but only when some market indicators have been met. And the market indicators are outlined on the right-hand side of this page. I'm not going to go through them for now. I want to continue with the timeline. On the 8th of June, the CFTC recommended the SOFR First initiative, which I mentioned earlier in the timelines. So in the inter-dealer trading conventions will switch from LIBOR to SOFR on the 26th of July. And what this means, or what the ARC said on the back of this announcement from the CFTC, is that they're expecting the market indicators for term SOFR to be available shortly after, very shortly thereafter. So we've gone through a saga, if I allow me to say, right? We've had a situation where a lot of participants would like to get a term rate. The ARC indicated already since back 2019, there's some papers from back then from the New York Fed that provide a methodology for the calculation of a term rate, of a SOFR term rate. So they indicate that they would like to provide it. The original timeline was that this would be done in Q2 2021, which is pretty much concluding in a couple of days. This was not the case. In March, the FCA came out and said that we do not think that we're ready to approve any term rate. This confused people and muddied the waters, because a lot of areas that were expecting for a term rate, or some areas that where a term rate is almost necessary, such as, for example, discounting trade finance products, they were confused. They said, okay, so if a SOFR term rate does not come, what are we going to do? The ARC quickly realized probably the confusion, plus market conditions changed, and then we are in the situation where we expect, with some relative confidence, that the CME term SOFR rates will be available or endorsed for use. They're already available. I'll come to this next slide. They will be endorsed for use at the end of July of this year, so in about 1 month's time. What is still outstanding from a US dollar term rate perspective is the use cases where the use of term SOFR will be permitted. This is again something that the ARC has taken from the United Kingdom. The UK RFR working group made it clear that term SOFR can only be used for some specific areas, primarily trade finance, Islamic finance, and maybe some retail loans. What the UK RFR working group wanted to avoid is what we would call an inverse pyramid, a situation where a lot more people use the term rate, which is a derivative of the underlying rate, instead of the underlying rate itself. We can come to the theory of this and whether this would ever apply given how big the derivatives market is, but I'm going to skip it for now. What you need to keep in mind is that in the UK, they limited the use of the SONIA term rate to a number of specific use cases, and the United States is expected to do the same. So this is something that we're still waiting to hear from them. I would be surprised if it's markedly different from what is happening within the United States. So this is where we stand with regards to the term SOFR progress. But as I said, the announcement in March created a lot of confusion. A lot of people started questioning, well, if we do not get a SOFR term rate, then what can we do? In addition, you may have followed, there's been a lot of concern within the United States and from the regional banks in the United States who claimed that SOFR does not reflect their funding costs, and which is a fair argument, in all honesty. And they started asking for being allowed to use alternatives to SOFR that may be better reflecting of the realities that such banks are facing. And what we have now is a situation within the United States where SOFR is not the only approved alternative for US dollar LIBOR. There are a number of them, and let's come to this on the next slide, well, in 2 slides. But before we do that, just to conclude on term SOFR, is that the CME term SOFR, CME being the Chicago Mercantile Exchange, that has been approved by the ARC as the vendor for the term rate when these market conditions have been satisfied. As we said, likely shortly after the 26th of July. their term rate has been published since the 21st of April. It is, according to the CME, compliant with the BMR in the UK and the IOSCO principles. And what is also very interesting is that the licensing of term SOFR is for cash market transactions, right? Not for derivatives. And also that licensing comes at no cost up until December 2026. So for anybody who follows the link at the bottom of this table or who looks for CME term rates, you will be able to get the most up-to-date term rates as published by the CME, and hopefully they will be able to apply later. But as I said, because it's not only this term rate in the United States, there's a few more that will come to a bit. But quickly before, when we're looking at sterling, I mentioned that we have Refinitiv and IBA. Both of these firms are publishing term SONIA reference rates. And because the methodology they employ is so similar, and because the input data that they use is so similar, you would barely be able to see the difference in the outputs between them. And I have plotted them here, and you can see that the solid lighter blue line, which random in this case represents Refinitiv, versus the dotted darker blue line, which is for the IBA rate, are pretty much exactly identical. So even though we have the choice to use one of the two term rates in the United Kingdom, unlike the US, where the CME has been approved as the only vendor for that, you can see that the difference between using the Refinitiv or the IBA term rate is negligible. But now this does bring us to the conversation that I've already initiated. What's happening in the US dollar environment outside the CME term rate or the ARC approved term rate? And let's have a look here. So there's been, in addition to term SOFR from the CME, there's been also a number of other credit embedding alternatives that have been launched for US transactions. And we need to, again, be very careful here. CME term SOFR is based on underlying futures and swap transactions of RFRs. Therefore, the CME term SOFR is also a risk-free rate. But a number of vendors, a number of private companies, if I may call it like this, are also offering other alternatives to SOFR, which not only have a term structure, but they embed that interbank credit premium. So economically, they're a lot closer to LIBOR. The most prominent one that has been around for a very long time is Ameribor. Ameribor is provided by the American Financial Exchange. As it's been available for a while, it has traditionally been an overnight rate, but we've already had a 1 month and 3 month fixing available, and the 6 month and 12 month fixings are work in progress. Similarly, Bloomberg is publishing as of March BISB, which is the Bloomberg short-term bank yield index, which is available in a number of different tenors. Only about a month ago, or even less than that, IHS Markit started publishing two rates, Critter and Crits. The one is a rate, an all-in rate. Crits, it's a spread on top of SOFR. But the two are pretty much equivalent, interchangeable if one brings in SOFR. That has been published, even though it's not available for licensing yet. And again, it comes in a number of different tenors. And the Intercontinental Benchmark Administrator has been working on the bank yield index. That's been work in progress for a number of years, even though it's not published yet. Only the test results are available, but they're investigating the options for licensing this rate for use. Again, what is important is that in the United States environment, we have SOFR, which is the preferred or the recommended alternative rate for US dollar LIBOR by the New York Fed and the ARC, but we also have a number of alternatives, and these alternatives do not only provide an alternative in terms of we're not going to use SOFR, but we're going to use the alternative, but they also give term fixings as well as the credit spread that is absent from term RFRs, including the CME term SOFR rate. Now, what we need to keep in mind is that the regulators have been incredibly vocal. They have launched, if I may call it, scathing criticisms of these alternative rates. You can see here on the right-hand side, Andrew Bailey from the Bank of England said that to those looking for an easy descent by substituting LIBOR for credit-sensitive rates that do not address all of the fundamental weaknesses of LIBOR, they risk much of the good progress that has been made. Actually, Andrew Bailey in that conversation at the second SOFR symposium was a bit of a winter storm in terms of criticizing these rates. And similarly, a little bit more recently, Gary Gensler of the SEC has also raised concerns about these rates, and he singled out BSBY in particular, but that's besides the point. What is the takeaway for us is that whether regulators like these credit embedding alternatives or not, these are here to stay. If we use them, we have to use them carefully. We need to understand the different economics as well as the risks that are associated with them as identified by the regulators. But in all honesty, and for the audience of this call today, outside the United States, the most important principle is asset liability. Well, in the whole of banking, asset liability management is an important principle. Outside the United States, that principle means that probably a SOFR first approach is the most prudent, because the ability of a bank that is based in Thailand or in the Philippines or wherever else in Southeast Asia of being able to raise funding on a LIBOR, for example, is going to be questionable, both from a practical perspective but also from a conceptual perspective. So please be aware that we have all these rates available, all these alternative rates available, but SOFR should remain the top priority for us as we move forward. Then, what does this mean? What is the so what of this discussion? Well, we have to make some key decisions. And obviously, we need to wait for the market leaders to converge, especially in some of the the leading financial hubs, but we need to make some decisions ourselves. Now, to be honest, this slide, even though it is fully updated for the latest updates, it is becoming a little more conceptual given the information that we have. Sorry, just give me a quick second. Within the sterling universe, we have, as I said, we have two vendors. The question is which one of the two vendors to use. Well, practically, as we've seen before, the rate is pretty much identical. There's not much of a difficult decision to use one or the other. Let's just use the rate that's included in our current data packages. With regards to US dollar, the question is, do we wait for the CME term SOFR to be endorsed? If you had asked me this question about 2 months ago, I would say I don't know, because I don't know when it's going to be published. As per the latest announcement from the ARC following the CFTC announcement, I think that we can all confidently expect, and I repeat, it's still an expectation, that the CME term SOFR will be approved for use on the 26th of July, in a month from today, and that will probably make things a lot easier. But let's watch this space. And obviously, we also need to make a decision. Do we want to use any alternatives? What for and how long for? But again, I'll repeat, a SOFR first approach is probably going to be the most prudent for us. I want to touch quickly on the RFR implications for Islamic finance, because I understand a number of your countries may be big on Islamic financing, and we do understand that there's a lot of implications coming out of these in arrears conventions in the context of Islamic banking. And they all have to do with the principle of Gharar, right? So we need to make sure that we avoid uncertainty in financial contracts, so that, to look at it in a more positive way, we need to provide certainty in financial contracts. And because these RFRs are backward-looking, determining the profit rate upfront may be very difficult, especially in the absence of a term rate. But now, as I said, term rates, at least for sterling, and hopefully in the near future for SOFR, will be available. And hopefully, again, just like the UK RFR working group identified Islamic finance as a specific use case for term rates, we would expect that the ARC, again, I repeat, this is an expectation, we would expect that the ARC will apply the same. If we want to follow an approach based on the CME term rate for Islamic contracts, at least we have a forward-looking rate that we can employ. But we need to keep in mind that because it's economically different, the profit rate calculation has to change, right? So this is, we may not have as much of an impact as we would have had if we had to use RFRs, but we do need to make sure that our profit rate calculations are performed differently. Where things start getting a little bit more complicated is because of IOFI's Standard 59, for the ones who have been following those developments recently. So starting from the top left, employing the term SOFR is likely the easiest approach for the calculation of the profit rate. But for any company that was that is using murabaha structures or the traditional, let's say, murabaha structure that has a tendency to roll over, then standard 59 may become a block in our ability to do so. And in order to address some of these concerns, well, this conversation, to be honest, has started well before standard 59 was finalized. The IIFM based in Bahrain has proposed a number of options that try to incorporate in arrears rates in Islamic structures. These, I'm not going to go into a lot of detail of them. For the ones of you that are in Islamic finance, I'm sure you've been aware. We can have the long-short structure, we can have a discretionary rebate approach, or we can have the return determined at the end of the profit period. We have to watch this space. The IIFM is working on this. I believe the next webinar that they're providing is going to be on the 8th of July, so in about 10 days from today, for anybody who wants to participate, if you can get access to it. But what we need to keep in mind, again, as the main takeaway is that if we can use term SOFR, in the case of US dollar linked Islamic transactions, using using term SOFR is likely going to be the easiest approach, taking into account, of course, the profit rate calculation. If we do not want to use it, whether because of standard 59, whether because we want to take into account any mismatches between, for example, our Murabaha and our Ijara structures or anything else, there are a number of different approaches. And you may have seen that there have already been a number of institutions that have issued Islamic loans, or they have borrowed based on Islamic principles using in arrears rates based on these different conventions that we have outlined here. And this brings us to the conclusion of our presentation. You're all central bankers of your respective jurisdictions, and I would just like to give you a little bit of guidance in terms of what would be prudent for you to follow. I mean, in terms of an overview, I'm not going to go through this. You probably know the progress in your respective area better than me. Just at the high level summary, we know that Singapore is leading the way. Now they have moved into a SORA-centered approach from the previously multi-rate approach. We know that Hong Kong, there's been some delays in what's been going on, and there have been some changes also that have been applied in terms of the Thai baht, in Indonesia as well, and so on and so forth. As I said, I'm not going to go through this at the moment. What I do want to go through is the following list. This, you can consider it as a useful cheat sheet, as something that you can have on the side of your desks to plan about how you want to go about the supervision of the transition in your respective jurisdictions. And you may well have already done so. I know that a lot of the countries are quite well ahead in terms of this, but just to make sure that we have some sort of common benchmark here for the audience. The following items are, in our opinion, and in the opinion of the New York Fed as well, to be fair, or the key examination considerations that should be pursued. So first of all, it would be prudent to ask all, if you haven't already done so, to ask all firms within your jurisdiction to outline what their transition plans have been and to what extent this aligns with the timelines for LIBOR that we've already mentioned. Similarly, you should ask, if you haven't done so, all the firms to accurately measure their financial exposures to LIBOR and be able to report that exposure to the senior management. It's very important that senior management within the firms that you supervise is aware of both the volume in terms of, let's say, US dollar value, but also the number of contracts that are going to be impacted and that they have to be managed as part of the transition. Operational readiness is another examination consideration. So all the firms should identify the systems and the models, whether these models are internal or provided by vendors, that use or require LIBOR, and also develop plans to migrate them, as well as contingency plans in the event that service providers cannot deliver the solution in a timely manner. And why may that be the case? Well, the reason is simple. Every single bank in the world at the moment is trying to make this upgrade. And even though most of the vendors that we're dealing with, they are quite clued up and they know what's going on, there's just a limited number of hands that can be used in order to make this transition happen. And the unfortunate situation is that in a number of our jurisdictions, we are bottom of the pile in terms of priority. The vendors will first make sure that they will address their US customers and the UK customers, and only afterwards they will come and attend to our requirements. Fourth point that is worth examining. from your local firms? Is there preparedness in terms of legal contracts? Have all the firms identified the contracts that reference LIBOR? Are they prepared so that all new issuances that are happening this year we can still issue in US dollar LIBOR, right? But we know that anything that's issued this year and has a tenure longer than 6 months is going to extend into the future when LIBOR, US dollar LIBOR, well, US dollar LIBOR may not be a very good example. As we said, that's going to continue for a while. But for the other rates, or for rates that will go, US dollar LIBOR referencing contracts that go beyond the 30th of June 2023. All these contracts should have a robust fallback language. And there obviously should be transition plans as well that can take into account all the steps that are required. From a communication perspective, again, please check, have the firms that you supervise communicate with the counterparties, clients, and consumers? Or would the transition come as a surprise? That should not be the case. Financial institutions are responsible to make sure that the clients are treated fairly and they fully understand the background and the implications of the transition. In terms of the background, there's very little we can do. This was an international development. We just have to follow suit. But customers need to understand what impact this may have to them, including in situations where they may end up paying more than before for the exact same loan. And obviously, with regards to oversight, you want to make sure that any transition plans have been provided to the senior management of the firm, and that senior management equally is also provided with regular status updates. So this is, if I may call it, a little bit of a checklist of aspects that is worth checking. And I know that a lot of you, a number of countries, are frequently sending either Dear CEO letters, or they have already implemented the process of quantitative and qualitative disclosures that need to be published with the central bank on a regular basis. But it's important to make sure that all of you are on the same page. I have been dealing with one specific jurisdiction where the central regulator had not made any announcements up until May this year. And obviously all the local banks now are scrambling to get ready, but the time that is left is unfortunately not sufficient in order to, in particular, update all the systems that are required. So just as a concluding remark, this is one of my favorite quotes coming from John Williams, who is the president and CEO of the Federal Reserve Bank of New York, who said, that was about a year ago, that some say only 2 things in life are guaranteed, death and taxes. But I say that there are actually 3, death, taxes, and the end of LIBOR. And this is my concluding remark. Thank you very much for your attention. And I'm open to any questions that you may have. Thanks a lot.
Thank you very much, Periklis, and that's a great quote to end on. I like that. Okay, so to all the participants, please do send through your questions now. This is a great opportunity to have answered anything that you are still unclear about. There was obviously a lot of detail in that presentation, so I'm sure there's quite a bit to digest, but please take this opportunity to raise whatever questions you want to. Periklis, we have one question here just asking about the meaning of the fallback language.
Yeah, that's an excellent question, and I'm glad people want to clarify. There's some terms that I may have used quite a number of times. Let's make sure we'll understand it. Fallback language is effectively a safety net that says what will happen if a trigger event occurs. In our specific case, the trigger event is the discontinuation of the rate or the unavailability of a rate, and the fallback language determines what should happen afterwards. Now, let's take a little bit of a step back. All contracts include fallback language. If you look at your facilities from 3, 4, maybe even 10 years ago, they do include some sort of fallback language, especially referring to what they call the unavailability of a screen rate. What is important to note, though, is that it's not a question whether a contract has a fallback language or not, but it's really a question of whether the contract has an appropriate fallback language. A fallback language that has been developed and can account for the permanent cessation of a rate such as LIBOR. Most of the existing fallback language was dealing with the temporary unavailability of the screen rate. Now we need to make sure that all new contracts include fallback language that allows for a permanent cessation of LIBORs, and we need to make sure that all contracts include that fallback language. And for any legacy contract that has an inappropriate fallback language, that fallback language needs to be updated with something that is appropriate. I'm focusing primarily here on loan contracts because from a derivatives perspective, you may well be aware that ISDA has published the LIBOR fallback protocol that does provide standardized fallback language for any ISDA covered transaction, simplistically speaking, any transaction that is using an ISDA master service agreement. I hope I have answered your question.
Yeah, thank you very much. Couple of other things here. First of all, are you saying that we, the central banks, need to choose on how to calculate the SOFR, and we should use that all the time?
Right. I'm glad again this question has been asked because it has a number of nuances that we need to address. SOFR is calculated.
Yeah, there was just a follow-up as well. Do we need to calculate the SOFR for everyday contracts, which is SOFR plus the CAS from ISDA?
Right. Okay, excellent. So let's start step by step. SOFR is calculated by the New York Fed. We do not have to, and actually we cannot calculate SOFR. What the lending firms within our jurisdictions have to do is they have to calculate interest accruals based on the SOFR published by the New York Fed. Right? Now, and as we said, there's a number of conventions. That's a personal opinion. You can, as local supervisors, you have the right to do what you think is appropriate for your jurisdiction. But generally speaking, it's not the responsibility of the supervisor to determine which convention for SOFR-based accruals is going to be used locally. And why am I saying that? Well, because a lot of the US dollar transactions are across the borders. So even if yourselves determine that you would like to use convention A, B, and C, maybe the counterparty, which may be Citibank or Goldman Sachs, they may have a different view. What you would need to do is to make sure that your supervised institutions can source these rates from the New York Fed or from an intermediate vendor. They can appropriately apply the accruals as per the conventions respective to this, and that they have made sure that all the contracts that are maturing beyond the date when the rates are ceasing to be published, that these contracts can migrate to the alternative rates. Just a quick point on the CAS. The CAS, at least right now, and again, what I'm saying is a little bit looser than the rest of the language I've used until now, but let's say that the CAS is a stopgap measure that we apply when we have a rate switch, when we're switching from US dollar LIBOR to SOFR. Moving forward, let's say in January next year, when a new loan is going to be issued, most likely the CAS will not be visible, but it will instead be embedded into the profit rate that we're applying, the interest rate, whichever way you want to call it, right? But obviously from a pricing point of view, we do need to make sure that our pricing does take into account the marginal borrowing costs that we as a bank would incur in order to raise this funding in the interbank market. Thank you for the question. That was a great one.
Okay, thank you. Few more questions coming up. Firstly, how do you view the impact on banks' risk management in view of the change in the reference rate calculation, especially the new calculation methodology, which is materially different from the current convention that's used in a lot of financial products?
Yeah, excellent. We have, just like everything else, the impact is so wide that we have to segment it. If we look at it from a market risk perspective, all our market risk management systems have to be updated, especially from a valuation and a VAR and a stress testing perspective. Why? Because we have to base these calculations based on the new rates. So market risk management, in summary, heavily impacted. Credit risk management, generally speaking, less, if at all. But if we take IFRS 9 into account, there could be a situation where the macroeconomic model that is used for calculating ECL may have a LIBOR macroeconomic parameter in it. Then that calculation is also impacted and needs to be refined. From a financial management and especially a hedge perspective, and I'm not just simply going to talk about hedge accounting per se, but also any hedges that we may have that are not designated hedges. Again, risk management needs to focus on basis risk there, because we can have a situation where the loan falls back to a 5 business day look back with or without observation shift, whilst the hedge, the IRS, falls back on the ISDA conventions, and we may have a difference there. Now, the IASB has issued a number of expedients from a pure hedge accounting perspective, but from an economic perspective, a basis will be there that has to be taken into account. IRRBB is another area that, again, risk management needs to pay attention to. The mechanics of IRRBB are likely going to stay the same. We're going to look at NII gaps, and we're going to look at EVEs. But again, the way that the inputs that are going into these calculations will change. We have to make sure that from a risk management perspective, these are taken into account. So you're absolutely right in your question. There's so many areas that risk management is impacted. And in all honesty, this is probably the most heavy area that we have been involved in as well as a firm, precisely because there's so much detail that needs to be taken into account that requires to take the content of the transition, a deep understanding of what's happening in the market, and to apply it in a way that makes sense for your institution.
Okay, thank you. Next question. To your knowledge, is there any progress on RFR for Chinese yuan at the moment?
At the moment, to be honest with you, I'm not very close to what's happening in that space because the focus has been primarily on LIBOR. So I would think that if I may, I can pass on this question, but very glad to receive an email and I can do my research and I get back to you.
Okay, yep. Okay, next question. So just a clarification. So LIBOR USD based contracts, which will mature before June 2023, can continue using LIBOR USD rates, except for 2 tenors in the interest rate. Is that correct?
Yes, it is correct. If it matures before June 2023, again, I don't want to say something. There is a concept of non-representativeness. So there is a possibility that US dollar LIBOR fixings will be deemed non-representative before July 2023. But at the moment, I would say that this possibility is quite low. So the answer to your question is yes. Even for the 2 fixings that are discontinued at the end of this year, the fallback is going to be an interpolation between the closest lower and higher available fixing there. So again, you will continue using LIBOR.
Okay, thank you. And this is a kind of follow-up question, but I'm not sure I quite understand it. But the question is, how about in your country? What's the practice regarding LIBOR USD based derivative contracts?
Right. So my my country is within the Eurozone, so I can talk on behalf of the, well, not on behalf, sorry. I can talk in terms of the Eurozone in general. For us, if we're looking at the loan contracts, Euro LIBOR is obviously a huge problem. We need to migrate away. Euribor is continuing. This is fine from a derivative point of view, and from a US dollar perspective point of view, the ISDA protocol, as you have seen, has been signed up to by the majority of large institutions within the whole of the Eurozone and internationally. And this is what is covering both the transition aspects as well as the conventions moving forward. So I don't think it's so much a question of what's happening within the ECB area. Globally, from a derivative point of view, we had a fair bit more progress. The ISDA fallbacks protocol is available for banks to sign up to. The conventions there are a lot more standardized. There are a few concerns that will come because of the fragmentation of the derivative market to account for the different conventions in loan products, but we can skip that. So yes, from a US dollar derivatives perspective, following what the ISDA guidelines is probably the most prudent thing that you can do at the moment.
Okay, thank you very much, Periklis. I think that brings us to the end of our questions. Oh, there is one final one, so we've got a couple of minutes. We'll just try and sneak them in, if that's okay.
Sure, we do have another 3 minutes.
Okay. So do you expect any significant impact of the transition to RFR on banks' effectiveness in using RFR-based interest rate derivatives to hedge on-balance sheet exposures such as bond holdings and so on? Okay, I'll let you answer that one.
I'm going to provide an unsavory answer, which is it depends. It depends on how well you apply the hedges. Conceptually, I can say no. We are expert people. Financial engineering has been something that banks have been doing forever, well, for a very long time, and we should be okay with that. But there are so many complexities that it's a lot easier to get something wrong. What I would recommend that you do is that you study how hedges have to be set up in order to make sure that you take into account not only the accounting basis, but also the economic basis that arise.
Okay, thank you. And then the final question for today, and this is more of a clarification. Can you explain one more time why the gap between SOFR and the spread and LIBOR is relatively wide? And can you explain what is the observation period and the interest period?
All right, let's start with the first one that we definitely have time for. SOFR does not include a credit premium. It's a nearly risk-free rate. LIBOR includes that interbank credit premium. Therefore, there's a basis between the two. If we were to take a timeline of SOFR and LIBOR for the last 5 years, we would see that generally speaking, LIBOR would be the line on top. We take the median difference between the two, and that is calculating the CAS. But because it's a historical observation, this is not necessarily reflective of the basis or the spread or the difference that we observe as of today. And that was the table that I spoke about earlier. In terms of observation period and interest period, I appreciate there's a lot of technicals that are coming here. Let's think about it simply like this. The interest period is the period through which a loan accrues interest. So a 30-day loan that starts today, the interest period is from today up until 30 days later. The observation period historically has been the exact same as the interest period. But for the purposes of RFR compounding in arrears, we have had, under some conventions, to decouple them. So as I said, if we have a 30-day loan starting today, the interest period starts today, but the observation period, i.e. the period for which we observe the interest rates to be applied today, starts 5 days earlier. So this is the difference between the interest period and the observation period. I appreciate this may still sound conceptual. As I said, happy to take any further questions via Aziz and via the SEACEN, and we can see how we can respond to you.
Okay, thank you. Yes, and that's so if you do have any more questions or you need any more clarifications, please do send us your emails and we'll pass them on to Dr. Periklis. Let me hand over to Glenn. Glenn, did you want to make any comments or did you have a question?
No questions, Aziz. I just wanted to thank Dr. Periklis for a really interesting presentation. I learned a lot, and thanks for taking the time to prepare and to speak with our stakeholders today. I think you've made a great sense out of a very complex matter.
Thank you, Glenn. I appreciate it.
Thank you. And we had a lot of attendees online. So it shows we had between 70 to 90 people during the course of the event. So there's a lot of interest for this kind of technical topic, and hopefully we'll try and invite you back at a future point as well to give us an update on where things are. But in the meantime, as you said, if anyone has questions, please do send them through to us and we'll pass them on.
With pleasure. Thanks a lot. Thanks for giving me the opportunity to speak to your audience. Thanks a lot.
You're welcome. Thank you very much. And to all our participants, we hope you enjoyed it, and please take care of yourselves. And we look forward to seeing you in the near future. Thank you and goodbye.